Welcome to Online Trading Campus. This is Jan Skorupinski with you today, continuing the new 2021 stocks course. Welcome to Lesson 5, the Chart Technician. This is the agenda for today. Yes, we've been talking a lot about fundamentals in the past lessons and how we can use them to up our stock market and equity index trading game. Now, let's talk a little bit about some add-ons for the Chart Technician. We're all chart technicians. We love the charts. And there are a few ways on how to become better at charting when it comes to stocks. I'll be introducing those tools in this lesson. One of the ways we want to look at stocks is using relative or comparative strength. Comparative strength allows us to be trading stocks that have been doing better than the index and other stocks, and therefore they are likely to continue to be outperforming. Makes a lot of sense, right? To be buying the strongest as opposed to the average or the weakest. We've already learned how to pick the strongest stocks based on the underlying fundamentals, buying the lowest price stocks with the lowest forward PEs relative to the index. But how does this really relate to the charts? How can we spot if a company has been doing better than the average? Let me show you. And in general, what a year this has been and how much learning we can take out of this year for the future. That's just incredible. This has also been the first crisis we've ever traded live at the campus, and every crisis is different. But a lot of things are usually the same. So when we talk about comparative or relative strength, this will be especially important when markets have a bigger drawdown. So here are the two big questions. What is a big drawdown, and how can we use comparative strength to buy into a bigger market correction to benefit the most coming out of it? And later, we will also talk about an advanced add-on for the chart technician, Gap and Run. Let's get going. What is comparative strength? Comparative strength is when we compare two stocks or a stock with an index, and we find that one has been comparatively stronger than the other. When we look at comparative strength and for buying, most important in this analysis are going to be the lows and how well they're holding up when stocks become under pressure. Let me show you the process here. The strategy is simple. When we have a market low, I want to buy individual stocks that are comparatively stronger than the Dow in terms of the lows they're making. So in theory, this would look like the following. On the left side, we have an index with a trend that has broken the prior low or lows. And on the right side, you have an individual stock that is holding the prior lows. In this scenario, the stock to the right is comparatively stronger than the index, and therefore we should expect a bigger move coming out of this low as opposed to the weaker index. In other words, this means that one has an existing trend structure while the other has broken the trend. Now there are two arguments. Argument number one is the index has been hit the most, therefore it is the cheapest and has the most upside potential. This is the more common argument, one that most retail investors follow, buying junk just because it's been beat up and it's low. The second argument, and the one that we will be following, is to buy the ones that are comparatively the strongest, the ones that have held up the best in this correction. And as you probably already know, without me going into the charts, which ones were the companies after the corona crisis that performed the best? Yes, the winners of this pandemic, Apple, Microsoft, Tesla, Google, Netflix, all those companies held their prior lows when the indices made a new low. And what those companies have done in terms of stock performance is history. But what a great learning on taking advantage when markets sell off. And this is what this looks like in reality. The Dow at the top is making a new low while Apple at the bottom isn't. When we look for buying, we want to buy Apple as opposed to the Dow as it's comparatively stronger. Caveat here is we want to look for the stocks in the Dow. Apple is part of all the indices, also the Dow. This just means that Apple is in stronger hands than the index, and we want to buy the products that are in the strongest hands. In other words, we want to buy the products where we can still see an existing trend structure. The great thing about comparative strength is that it is very universal. It also works when we look for selling. We want to sell the ones that are in the weakest hands. And it also applies to all our markets within certain future groups. For example, when looking at the precious metals group, we can compare the markets we want to buy and choose the ones that are in the strongest hands. The same rule applies. We look for the lows and choose the market that is in the strongest hands. In this case, it would be silver. And when we look to sell, we can also apply the same rules here, but instead of looking at the lows, we will have a focus on the highs. Makes sense, right? Because we want to find the weakest products, and weakest generally is shown in the highs as opposed to strength in the lows. So in this case, which product do we want to sell? Crude oil or natural gas? Right, easy enough. We want to sell natural gas within the energy group because the highs are clearly holding and therefore the sellers are clearly in control. In summary, comparative strength is an awesome tool that allows us to pick the strongest products within the group, whether that's stock, precious metals, energies, or any other group when buying, and the weakest ones when selling. When we look to buy, we're looking at the lows, and when we look to sell, we want to look for the highs to be holding up. This makes so much sense in terms of charting, right? Of course, this is charting 101, but it really helps to put this in writing with a clear set of rules, because sometimes we tend to forget the simplicity of charting and the importance of direction and how direction can help us sorting through different products and choosing the ones that make the most sense also from a technical perspective. Charts are great, aren't they? They help us visualize all of this without fundamentals. We know which ones are going to be the strongest and which ones potentially the weakest going forward. When it comes to stocks, this works best when the entire market is selling off, and we would only buy them once we get a buy signal in the market. A buy signal looks like the following. It happens rarely, but when it does, we need to take advantage of it. And how? We buy the comparatively strongest stocks in the basket. The criteria that has to be met for a buy signal is simple. Price must be in monthly demand, and our campus indicator ideally should be flashing green. And look at the Dow Jones here. In and around the time when the campus indicator flashes green, we want to look to buy big time. Here, 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 and here. You get the point. Mortgage all you have and be fully invested. I'm kidding, of course, at least when it comes to mortgaging your belongings. Here is Microsoft. By the way, in these charts, you see the DJA, which is the Dow Jones ETF. This is just because TradeStation has problems comparing different time frames that the Dow Jones futures are trading compared to stocks. Lower low here on the Dow, higher low here on Microsoft. This just means that Microsoft is comparatively stronger than the Dow Jones as it held the lows. Look at Walmart. Another example, but the same story. Higher lows, continued uptrend, and as a result, Walmart, Microsoft, and Apple, we should have anticipated to be the winners of tomorrow. In the rearview mirror, it's easy to say who the winners are and then come up with some fundamental reason for it. But the point is that this can be spotted in the chart beforehand. We can use comparative or relative strength to anticipate the winners of tomorrow when the market sells off. Here are the rule cards for the strategy. Whenever price is in monthly demand and or our campus buy indicator is flashing green, we can look to do the following. When we get a buy signal, we want to buy 5 stocks that are comparatively stronger than the index, in effect creating again our own equity index with all 5 trades taking on the same weight, 20% of equity per trade. You can backtest this yourself. Look at also 2009 or whenever an index was in monthly demand and compare the same time frame with individual stocks. It works like a treat. Also, we can use our Campus Buy indicator on all stocks, and we can look to buy individual stocks with leverage all year round using monthly and weekly supply and demand, as well as the buy indicator. Since we're in a technical analysis lesson, let us also talk about some more shorter term tools to trade stocks and get into stocks when and if they're ready in terms of buying or selling points. You probably know that this is coming. Gap and Run. Gap and Run is an advanced tool for the stocks trader. It is a very versatile tool that can be used for short-term trading, but also mid to long-term trading, with the idea to get into longer-term trades using tighter stops and therefore maximizing profits. This is the agenda for Gap and Run. At first, we will talk about the trading prerequisites and experience level you should bring to the table before executing on a Gap and Run trade. After this, we go straight into the strategy, what it is, and what to look for in markets. We're going to form a clear strategy with clear rules and black and white process. And afterwards, I'll show you how to implement an automated Gap and Run scanner that will help us sort through all of our stocks, which speeds up the process. Gap and Run is one of the most advanced trading strategies that I know of, but also can be one of the most profitable ones. That is why there are a lot of prerequisites before you trade Gap and Runs. Let us quickly cover them before we go into the strategy. First and foremost, you need an extensive understanding of supply and demand. By that I mean the higher timeframe supply and demand context in terms of higher timeframe location and higher timeframe direction. Gap and Run is just another way to execute certain trades, and ideally we go into trades that align with the right higher timeframe context. So uptrend, price is low, positive seasonality. We want to look at gap up and run. We want to buy. Or downtrend, price is high, negative seasonality. We want to look at gap down and run. We want to sell. Don't worry, I will set out rule cards more specifically later on. Secondly, you need an extensive understanding of price action. By that I mean bigger picture technical structures like trend lines, megaphones, or head and shoulders. Thirdly, of course, you need an extensive understanding of reversal candles. You need an understanding of what a hammer candle is, shooting star, engulfing, or hanging man. These will form the basis for our entries. Supply and demand we use to understand the direction we want to trade with and where price is likely to turn. And reversal candles will be used as an entry point. And lastly, and this is one of the most important pillars of Gap and Run, you need an extensive understanding of yourself. This is a day trading strategy that is extremely powerful, as we generally would over leverage ourselves using tight stops. So this can be extremely nerve-wracking for a beginner. You'll find that it can happen that you are in and out of trades within minutes or seconds. And then there are times we should look to re-enter and times we should be on the sidelines after being stopped out. So you need to know yourself, your limits, and you need to know that you can follow your own rules. This is so important that this is the first golden rule. And here, please be honest to yourself. If you find yourself sometimes breaking your set of rules, so-called cowboy trading, where you take trades you're not supposed to take, then stop right here. Skip this lesson and come back after you have formed a trading plan which you have abided to and lived by consistently. Awesome. All right, so let's talk about the strategy in more detail. Gap and Run is a day trading strategy that can be used to get into stocks when we see a buy or sell point in the market. Particularly important here is that Gap and Run does not give you the license to participate in the market where you otherwise wouldn't. Rather, it should be seen as an add-on, an additional tool you can put into your toolbox. And just like any tool, there's always a certain time and place to use it. The 3-step supply and demand analysis is also the foundation for this strategy. And only if the foundation is giving, all our rules are met, then we can look to use this strategy to enter the market. Really what this is a different way to execute trades, to get into trades maximizing profitability. As of now, you probably know how to set and forget trades. You know how to trade price action, and now I will show you a third way of entering stocks, which is gap and run. There are 2 ways on how to use gap and run for entries. One, we can trade stocks where we see a bigger momentum shift in the market, basically looking for price action reversals inside or coming out of our weekly and monthly demand and supply zones. And 2, and this is where gap and run differs from supply and demand, we can look to enter stocks with the momentum, allowing us to trade stocks even when going into an all-time high. Again, gap and run is a day trading strategy. This means we cannot set these trades in advance. We have to sit in front of the screen during a specific time of day, which is the open bell on Wall Street. As the name suggests, at that specific time of day, we would be looking for gaps in the market and trade with the direction of the gap. As all of you know by now, stocks are only open during a specific time of day, the so-called regular trading hours from 9:30 a.m. to 4 p.m. Eastern Time. Prior and after that, stocks still trade and move in price. This is the so-called Globex session, the pre and post trading session. And since stocks move during this time, they oftentimes gap into the open of the regular trading session. You can see these gaps here, here, or here, and many more of them as a matter of fact. We call them gap ups and gap downs. If a stock opens higher than the close of the prior day, this is called a gap up. If a stock opens lower than the close of the prior day, this is called a gap down. When it comes to the strategy, not all gaps are the same quality. There are certain rules that need to be in place for us to trade a gap into the direction of the gap, basically trading a gap up long or gap down short. As you can see here on Apple, there are many gaps, so we need to form some rules to determine a high probability of follow through. Basically, we're going to ask whether a trade has legs to it. Let us inspect them a little bit right now and just talk about each gap before the rubber meets the road and we formulate our game plan, bringing pen to paper. The first gap is a so-called gap down. You can see that price opened lower than the prior day close. And as you can see, there was a lot of follow through here. This trade clearly had legs to it. What about these gaps down here? Price traded higher immediately with a lot of momentum. Also, here clearly these trades had legs to them. What do these 2 examples may have in common? Yes, both come from daily and weekly reversals, indicating momentum shift on a higher time frame. Also, the gap up resulted from price coming out of monthly demand in an existing uptrend. Okay, so let's move on. What about the third gap? Is that a gap up or a gap down? Clearly a gap up. Price opens much higher than the prior day close. Here, price is gapping up into an all-time high. Clear momentum to the upside. And lastly, the last gap is a gap down. Notice the trade had legs to it. Why? Daily bearish engulfing candle. Now, what is remarkable to see is that the gap ups are clearly stronger than the gap downs. Why is that? Well, because the trend is up. So the higher time frame context should be to be bullish. And the gap downs, shorts, would only be shorter term counter trend trades. Here is a general building block. As you can see, there are going to be a lot of layers when taking a trade, but the layers are like all other trades you take, right? So in terms of the overall strategy, nothing changes. The foundation of every strategy is our 3-step supply and demand process. I'm especially interested in the higher timeframes here. What is the higher timeframe trend? Where is higher timeframe demand and supply, and therefore where is price likely to turn direction? What is the seasonality? Is it bullish for stocks or bearish for stocks? Is the yield curve bullish or bearish? This is, however, optional. It just gives us an additional context. Now, if price is at a buy or sell point in terms of supply and demand, and ideally seasonality is in our favor, we wait for price action reversal candles to be formed either on a daily or a weekly time frame. If they are, we want to scan the markets for a gap into our desired direction. And when this happens, we want to look to trigger an entry. How exactly we will enter? Let's take a look at that now using a practical example. This is a hypothetical example to show you how this strategy applies to the real world of trading. An example which has actually not yet played out, but may be playing out in the future. This is a weekly BABA chart, Alibaba. I chose this stock because the higher time frame weekly analysis in terms of location and direction is straightforward. There's a weekly level on top of level at the $220 mark, which is also monthly demand. It is a flip level and the origin of price going into a new high, creating a higher high which continued the trend also on a higher time frame, meaning it is also an uptrend. No brainer to buy Alibaba when price comes back into the demand area, as we would expect price to turn here and continue going higher, maybe eventually even going into an all new high. As you can see, the analysis does not change. The foundation is supply and demand as per the usual. Let us pretend price is coming into our demand areas. For us, it is now time to take a decision. We have decided that we want to go long. However, there are now several options on how to execute and enter into this trade. There is the set and forget and get a live approach. We just set the level on top of level as per our rules and forget about it. The advantage here is that there is absolutely no screen time required. We just place the trade and go about our lives. What could be the disadvantage here though? For once, we may miss the trade if price does not go as low as the $207 mark, the level on top of level. And secondly, even though this is a super high quality level, it is actually quite large, and therefore, if we set the entire zone, the profit margin in terms of risk to reward is only average, maybe a 1 to 4 and higher if this goes into an all-time high. The next option is to wait for a lower time frame reversal, such as a daily hammer, to be shown here, and we would enter based on price action the next day. The advantage here is clearly that we cannot miss the trade, and the profitability is clearly better, assuming the same target price, close to a 1 to 6 as opposed to the previous example of 1 to 4. The disadvantage here is added screen time, and that price may still go lower after the entry. And as we're not protected with the stop loss all the way below $190 per share, this becomes a more aggressive trade setup. 1 to 6 is quite good, but is there even a more profitable way on how to trade this? The answer is yes, but as always, a higher profit margin usually comes with a more aggressive way of trading. And this is exactly where gap and run comes into play. Everything until now should have been things you already know. Now, if price gaps up the next day, it becomes a similar trade as the price action one. We enter above the daily reversal candle. However, the difference will be the stop loss. The rule here is we buy as soon as the candle turns green, with a stop just below the low of the new daily candle. As a rule, once market opens, I would usually wait a couple of minutes until market calms down, because markets can be quite random and volatile at the open bell. After 2 to 5 minutes, we look at the candle. If green, we just enter it by market with a stop below the low. As you can imagine, quite a hectic way of trading, and we may even get stopped out 1 or 2 times before this goes into our favor. But if it does, you can see the profitability just skyrockets to a 1 to 15 or 1 to 20. Sometimes, if the gap is not too large, like here for example, it also makes sense to put the stop also a little bit lower, either just below gap fill or even below the daily hammer candle, which then in turn becomes a combination of price action and gap and run. As you can see, there's no right or wrong here. It's just different options on how to execute, and depending on how much you want to over leverage, you would choose either entry. If you remember the second pillar of the strategy, seasonality and fundamentals, during times of highly favorable seasonal times, I like the gap and run approach as it allows me to put more money on the table, especially during daily seasonalities like holiday seasonalities, as in the Thanksgiving rally or the Santa Claus rally. I like the gap and run game because these are designed to be shorter term daily income trades, and therefore a daily income strategy works pretty nicely for those. We will talk about these holiday seasonalities in the next lesson, building on gap and run. For practical applications, you can go to the library as well, go to signature and gap and run, and watch the sections here to find some live trading examples of gap and run, just to drive home your understanding on the way we trade these. So far so good. Let us form some rule cards for you to print out and put into your trading plan, starting with the gap up and run. We must wait for a lower time frame candle to be a bullish reversal candle coming from our buy points. We enter the next day at open bell if there is a gap up and the candle turns green after 2 to 5 minutes of market open. Stop loss must be below the daily low. The gap down and run is just the opposite here. We must wait for a lower time frame candle to be a bearish reversal candle coming from our sell points. Enter the next day at the open bell if there is a gap down and the candle turns red after 2 to 5 minutes of market open. Stop loss must be above the daily high. And here are some additional rules. Since we may get stopped out multiple times on a single trade, we must have a limited number of trades we can take on a single day for a single stock. This should be the maximum of 3 trades per day. This is just a self-destruction protection rule. As per any strategy, this is new to you, and therefore you should test this with either demo and or a live account if you're already trading live. And if you're trading live already, use a smaller risk size. Recommended here is a fifth of your normal risk size, or even lower, as the zones we trade are about a fifth the size of a normal daily zone. Only once you have a proven track record with gap and run entries, you can increase your risk size. And in terms of trade management rules, stop to break even and targets, use the same parameters you have for your normal trading. Only once you're advanced, you should be holding them for longer. Before we finish this lesson, I want to show you how to create a scanner for gap ups and gap downs in TradeStation in a few simple steps. On a new workspace or worksheet, you can go to Apps and select the scanner option. If you do this, a window will pop up, which will be your scanner. On this screen, you can see My Scanner, which has already been created, but I will now walk you through the steps to do this. The first step is to create a custom symbol list. This we need later as a proxy so that our scanner knows what markets it should scan for. To do this, we just go to Data inside the scanner window, go to Edit Custom Symbol List, Create Custom Symbol List. Here, just choose a name, like Campus Stocks List. And from here, you just add all the stocks using their ticker symbols and press enter, like Apple, Tesla, and Google, and so on and forth. And at some point, you should have a full list like shown here. What I also want you to add is add the following: at es.d for the S&P 500 regular trading hour chart, at ym.d for the Dow Jones, and at nq.d for the Nasdaq. This is important because we will also be trading these indices with gap and runs from time to time. Next step is to create the scanner. Here we actually need 2 different scans, one for gap up and run and the other for gap down and run. Let us start with gap up and run. On your scanner window, go to Create Scanner on the top right, call this OTC gap up and run. The first thing to do is select the custom symbol list we just created. Go to Next. Now we can select the criteria. This is quite simple. For a gap up and run, we want the open of today to be greater than the close of 1 day ago, yesterday. And since we want the candle to be green, we also want the last price to be greater or equal to the open. And voila, click on finish and you're done. Now once more for the gap down and run scanner. On your scanner window, go to Create Scanner on the top right. Call this OTC Gap Down and Run. The first thing to do is select the custom symbol list we just created. Go to Next. Now we can select the criteria again. For a gap down and run, we want the open of today to be lower than the close of 1 day ago, yesterday. And since we want the candle to be red, we also want the last price to be lower or equal to the open. And voila, click on finish and you're done. Now you have a gap and run scanner, which you can sync to your charts by clicking on the top right symbol, S. If you do this, your charts will automatically change to the symbol you click on in the results tab of your scanner. Alright everyone, this is the end of this lesson. Up next, holiday special, which are shorter term favorable seasonalities for stocks like the Santa Claus rally or the Thanksgiving rally, and many more short term and hence perfect suited for gap and run trades. Until then, thanks everyone, happy and safe trading, and ciao.